Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'll be hosting our webinar for today. Thank you so much for joining us for today's Lunch and Learn. Today's webinar will focus on a topic that has been a hot button for so many of us over the last couple of months, and it's inflation. Graham is going to share his thoughts on this as well as touch on some current market conditions. As always, there's going to be a Q&A session at the end of our discussion, so please get your questions into the Q&A section of the chat box, and I'll make sure that all of those are forwarded on to Graham so that he can answer those for you. And as a reminder, you'll see Graham's calendar pop up periodically throughout the presentation. If you would like to schedule some time with Graham or anyone from our team, please click on that calendar when it pops up and select a time and day that work best for you, and we'll circle back and get with you on that. And now I'm going to turn things over to you, Graham.
Hey, thank you, Stacy, and thank you to all of our attendees. Thank you to our clients who are on the call. You know, this is an important call. This call right now is we're really going over and we're going to address head on what's really been some of the biggest concern and anxiety in the market, and that is inflation. That's the cost of goods and services that you and I are going to have to deal with on a regular basis. The effects of the Fed on inflation. Can they get a handle on it? Can they bring it down? And is that going to push us into recession if we aren't already there? So yeah, I think addressing inflation is probably, without question, definitely something that is kind of the linchpin, if you might, to make a decision that this market can base here and grow from, or is there more pain that we need to expect in the future here? So let's go ahead and jump in. But before I get into all the details, I do want to wish everyone a great 4th of July. I know this is our last call before we get into the 4th. We'll be closed that Monday in observance of, but I wish everyone a great 4th. Please have a safe and happy holiday. But to start out, I know it's been painful. We know the markets are down 20, 30%, 18% respectively between the Dow, the S&P's down roughly 20%, and the NASDAQ down 30%. We have whole sides of the market, and I know I'm preaching to the choir to some out there, that whole sides of the market that are down 30, 50, 70, 80%, and it's painful. But what we generally want to lead with, and it's a hallmark of Wickham and all my team here, is that we want to lead with education. I'm an absolutely huge believer that when we're informed, that we can make better decisions. They tend not to be emotional decisions. They tend to be solid business decisions. And you made a solid business decision to allow us to manage your assets, not just through good times, but also challenging times. And that isn't lost on us. We understand that's a huge vote of confidence, and we don't take that lightly. I do want to make that really clear. But the best thing that we can do for our clients is have that plan, manage to that plan, make some adjustments, generally small ones around the fringe, as we always say, as needed. And we know time can take care of what we're going through. So let's go ahead and jump into inflation. I mean, this is the hot topic, right? So let's look at inflation by the numbers. All right. So pre-pandemic, we had inflation about 2%, right? Relatively low over the last 10, 15 years, relatively low, two odd range, 1.9, somewhere in that range. We currently have the CPI, the Consumer Price Index, at about 8.6%. But if we look at certain sides of the market, year over year, I mean, the change has been astronomical, right? We go to the pump, look at fuel prices up 107%. You know, we see energy up 35 and used cars up 16, new cars up 13, food, some of the areas in the food area on average up 10, 6% for shelter, housing, home. Again, some of those areas in that are higher than even 6%. We see apparel and those type of goods up 5%. So it's everywhere, right? You really can't avoid it, right? So what do we think is going to happen with inflation? Well, you know what? History leaves some clues, right? It has some rhythm, as I always say. It's not a crystal ball here. Not necessarily is the past going to repeat itself exactly, but we can look to the past to give us some ideas. Matter of fact, we can look at Jim Polson. He's a chief investment strategist over at the Luthold Group. So we're going to use some of his information today. You might have heard me bring up his research on previous calls. But I think he introduces a really interesting article where, yeah, it's disturbing, the latest inflation report, but we might be near a peak in his comment, right? So we're going to break down certain areas during this call. We're going to get into energy prices and look at where we're at and is it peaking, commodity prices. We'll look at the 10-year treasury. We'll compare that to the Fed funds rate, right? We're going to look at service prices, core inflation, CPI, right? Used car prices, so we'll break some things down in a little bit more detail. We'll look at world container freight. Now think about it, world container. When was the last time you thought about world container? Well, think about it. If you got to ship goods from China over here to the United States, and that's 100 to 300% higher in cost. Well, that's going to be added on top of the sticker that you pay for, right? So it does matter. All these little things matter. And we're also going to be straightforward. And Jim makes a good point. Not everything's going to come down. Maybe it's just not going up as fast. Or maybe it's still going to go up, but other things are going to pull back, right? So we want to keep that in mind as we go through this and we start looking at these numbers. We'll look at retail inventories versus retail sales. Look at wage pressures, which I've said in multiple calls. Very sticky, hard to bring down. I have an incredible team here. I'm sure my team would not appreciate me giving everyone a raise one day and then saying, hey, inflation's down, I'm going to go ahead and take it back. It just doesn't work that way, right? So wage pressures is very sticky. It can stay higher for longer. Heck, inflation is going to stay higher for longer. It doesn't mean after we get done looking at this great report that Jim published and everything's roses. It's not about that, but it is giving you some ideas. There is light at the end of the tunnel. It's not all horrible, and we'll get past it. And maybe the what's causing most anxiety now, causing all these other things to come into play, like the Fed, so on and so forth. Maybe this inflation's peaking. And then last but not least, we'll look at some inflation surprises. All right. So let's go ahead and jump in and look at Jim's report on this. So, basically commenting that, inflation CPI number is 8.6%. That's the highest that we've seen since 1981. So yeah, we really do have some high inflation. I mean, I don't need to tell you that. We all know it. We're all living through it, right? But it might be topping out, and that's where we want to spend some time. So let's jump in on energy. This is the one that I really feel that, hey, it might not be topping out, but the aggressive moves, if you look at chart one here that we added from Jim's report, it looks like the velocity of energy prices, maybe it's not going to be as aggressive on the upside. Maybe the majority of the increase in energy prices, that velocity, that real powerful push up is going to be less, but it doesn't mean that's going to come down a lot. This might be one side until we get some resolution in the Ukraine-Russia war. This might be one that just stays stubbornly high for a while. But keep in mind, if we get any resolution, because we know wars don't last forever, right? If we get any resolution, that's likely to, at least in the short to intermediate term, bring prices down, right? In the energy patch. If we go ahead and move forward and we look at commodity prices. So when we're talking about commodities on the left side, is where we have a chart. Jim puts one in. We're going to be talking about agricultural soft goods. We're going to be talking about industrial commodities. So look at this chart, and I'm going to try drawing on here. My team always laughs at me because I'm sure I'm going to mess this up. Let's see if we can get this right. I'm going to draw, but look at this right here. Look at this top, right? And look at it. It started moving sideways and really starting to fall. Some commodities a lot more than others. We're seeing ag really drop. You're seeing lumber really drop on the right side. Look at this chart. Look, we really peaked over here in about to what, January, February, March timeframe. And then look, we still really started ratcheting down. I think it's really interesting because as we've raised mortgage rates, I feel like maybe what, 6-8 months ago, On a 30-year, you could probably get it at 2.6%. Now it's over 6% or right at. I mean, that's still less than it was, previous periods, but it's a lot higher than where we're at, 200+%. So that's putting pressure on the housing market, right? We don't have any comment in here necessarily about housing prices because we haven't necessarily seen those roll, but we do know that if you raise mortgage rates up to a certain point and then you start putting pressure on people's discretionary income, that's going to naturally affect the housing prices. So we do think that housing is probably going to moderate, but this is our comment on that. Jim doesn't make a comment at this point in this chart. But we are seeing a flattening, and then we are seeing it start to decline in March. If we go over and let's look at service prices, right? May service price was at 5.2%. That's the highest level we've seen since 1991. Headline and core inflation rates could decline even if service inflation increases. So that's something that I wanted to point out. Like everyone's waiting for a flag to wave. Inflation is done, the world's better, all this kind of stuff, and then everything's just going to turn over and be perfect. Well, think about this. Some things might be stubbornly high, wage pressures, maybe energy. Some things might continue to go up, maybe service side, at least from Jim's statement, but you might see some of the other areas already start to decline. And imagine this. Let's say, for example, that this does play out and we do get a peak in inflation and some areas are really starting to decline. Boy, what could that do to the markets? What could that do to the equity markets? What could that do to the bond markets? If the markets came down because of inflation, what do you think they might do if inflation is flat to potentially going down, even though it's not going to go back necessarily to where we're at 2%. It doesn't mean we can't, over time, start to get it down. If we think about core inflation, right? So the last 2 months, the annual inflation rate has declined in the core CPI, in the PCE, and the producer price index. So let's look at the chart over here. I'll go ahead and do my my drawing here. Looks like I have a shaky hand, but look, you are seeing some peaks right here. Look at that peak, and then we're starting to come down. Look at the peak, and we're starting to come down. Peak, we come down, maybe moving a little bit sideways here, but we're still making some pullbacks on the PCE, even though it might be moving sideways. Now, I can't say, of course, there's no crystal ball, and I don't think, I don't want to put words in Jim's mouth. I'm sure he'd say this. There's no guarantee that it's necessarily coming down, it's going to stay down, but we are seeing some solid trends that have been in place for a good bit. Now let's move to used cars, right? Think about this. Used car prices up 40 and 50%. Now, I know I'm going to make this statement, and you're going to be like, Graham, it's still going up, and it is, right? But it's the pace, right? So used car prices increased 40, 50%. But now we're seeing the pace of used car prices dramatically less, only increasing 10%. So yeah, that's a small victory, but a victory just the same. And if you look at the charts don't lie. They're going down, right? The more pressure you put on the consumer, let's say the anxiety of cost all around us, from going to the grocery store, putting fuel in that car, going on vacation. I mean, yeah, now we're seeing some of those prices starting to come down in some of these areas. We can continue to look at world container freight, and that's what I mentioned at the very beginning. When was the last time you thought about world container freight prices? But it's huge. I mean, this is going to be translated. It's going to be added to the sticker price on the goods that you purchase. So think about it. If freight was up at these levels, and now we're moving down to these levels, do you not think that that might not be passed on to the retailer? The retailer is going to have lower pricing that maybe he can pass on to the consumer. Think about that. Let's think about the profits. Let's think about profit margins. So we're not seeing necessarily demand diminish from the consumer, right? So the demand's there. We're seeing those numbers still there. Demands for goods and services there. It's shifting maybe from goods to maybe experiences, right? Maybe some service areas, like travel and so on and so forth. But from the sticker standpoint, if the consumer doesn't have to pay as much, let's say they buy more goods. Let's say the retailer, doesn't have to suck it up if they can't pass it on to the consumer, then all of a sudden the profit margins look a little bit better. Now, we do think the profit margins are going to be affected. They're still a little bit high, in some situations a lot high, so that needs to come down, but maybe that's already been coming down, and we're just waiting for these numbers to show up in the CPI figures that we'll see here in July. If we go a little bit further, let's look at retail inventories. Remember that. Look at this. Inventories being the blue line, and then we're looking at retail sales coming out on the red line. Inventories has finally caught up with sales. Remember the supply chain. Listen, the consumer wants the goods, but they can't get it. So you have all this ordering. It's a delay on when they can get it made, but the order's still there. They've got it. It's shipped to the retailer. But all of a sudden, now the consumer's demand for that might have waned and has shifted in some other areas. So we got higher inventory that the retailers can pass on to the consumer. The consumer can enjoy lower prices while they are being pressured in other areas from inflation. So again, some areas are alleviating the pain where energy might stay, or services might stay stubbornly high. So I think that's a really interesting chart. If we look at overabundance and inventory, as I mentioned before, they can pass those discounts, to the consumer, and it can show up on the shelves, as Jim would point out. Let's move over to wage inflation. Now, this is one that I think is just really, really sticky. If you're a client, you've been on these calls before, you know how I feel about wage inflation. I'm like, oh, that's one of the worst ones, right? Consumer inflation tended to lessen when wage inflation was this far above CPI. So think about this, creating considerable downside pressure on headline rates. But look at this. If we look at the 4-month annualized wage inflation, this left side chart, we can say wage inflation is actually coming down, right? Down to about 3.75% from the 5.5%, right? And then if we look at annual wages, which are starting to come down, right? So as wages come down, consumer prices come down, everything starts to drift down. A little bit linked up, a little bit hand in hand. And again, we need time for this to show up in the numbers. Hopefully we'll see some of that in July, but I want to get everyone prepared. And I think it's really interesting that we probably are already at peak inflation and we're starting to come down. Let's think about inflation surprises, right? Now let's look at the economic momentum has slowed substantially. All right, so let's talk about gross domestic product, the growth, let's say, of the United States, right? So we had a gross domestic product, real GDP growth of about 12.2%, all right? Now we're in the second quarter, we're expecting gross domestic product to come down to about 2.5 or less, right? That's moderated considerably. I mean, look at these charts. Look at these numbers. I mean, these things are coming down. They're coming down, right? Now, normally, I would say these are horrible. You don't want growth to really slow, but to stave off inflation, so the Fed doesn't have to be so aggressive and potentially push us into a light or possible recession, you have to have these numbers come down, right? So it's almost at this particular point, we need the negatives to actually help us be positive. So it's kind of changing the mindset a little bit on how we've thought about things before, right? So there is light at the end of the tunnel, especially when we look at these inflation numbers. Finally, and I want to leave plenty of time for Q&A here, my final thoughts on this. Inflation, and I think Jim puts out a great report. Hopefully everyone's kind of, reading into these numbers like we are, because I think it's very much in our face, is that inflation isn't going to go away overnight, right? This is a process. Just like investing is a marathon, it's not a sprint. When you go through these periods, and they're horrible periods, no one wants to be down on their portfolios, no one, right? But let's think about this. We'll get through this. The average recession lasts about 15 months. Arguably, depending on when you feel if we've been in a recession or not, the markets already start to rebound before we even get statements that we're officially in a recession, right? So the time to be very pessimistic might have been 6 months ago, 9 months ago, 12 months ago. I think it's reasonable to be more optimistic, especially with the report that Jim put out there. And keep in mind, quality. You own quality, it never goes out of fashion. We said this over and over and over again. You're going to get surprises in the portfolio. Things happen, right? You're going to get moments of clarity in the markets where you rally 6, 8, 9%. Then heck, the next week it goes down 6, 8, 9%, right? It doesn't mean the picture's changed. It just means the market is now optimistic and now it just got pessimistic. But keep in mind, this too shall pass, right? But again, it doesn't negate that inflation is going to take time to come down. I do not think the 2% mandate by the Fed's inflation mandate, where they wanted to get inflation and keep inflation, is realistic. I think inflation is going to stay stubbornly high for longer. That's why we need to focus on quality. You need to have a plan. You need to be patient. You need to work that plan. And you know what? We'll get through this, right? It might take 6 months, a year, maybe a couple years to get inflation, maybe towards the 3.5%, 4% range. Hey, maybe it goes lower than that. You know, I probably think the 3 to 4% range over the next year or so is probably much more realistic. We'll just have to see if that comes true. Stacy, so we can respect everyone's time today, we want to open this up for a little questions and answers.
Absolutely. But before that, do you have any thoughts on how portfolios might be managed through this?
Well, as I said before, you know, we're huge believers in education here. We're big believers in plans. When you have a plan, you know what, and things that are outside of your control kind of go awry, at least you still have a direction, right? I think first off, you've got to have a plan in place. What's your plan? Is it to be all in or all out of the market? Well, that's a plan, but that seems to be more of a panic, and a panic doesn't seem to be a plan to me, right? Because we know this will pass, right? Even if the normal recession causes the S&P to go down 30-odd%, it's only been down 24, 25 intraday, roughly. So there could be more pain before we get pleasure. But there's no reason why, you know, we can't be stabilizing here and starting to find our way back up, and we just take some time to get there, right? So I think creating a plan, as I mentioned before, owning quality investments. I love investments, one, that can beat inflation, ideally, that have dividends, strong balance sheets, that are profitable, right? Have a diversified portfolio of that quality internationally, domestic, small, mid cap. Just own quality. You can have certain spots of your portfolio that are of higher risk. That's okay, right? Because you're going to need it. Because when the market decides to realize that this too shall end, this market is going to rip higher, and you know what's going to rally the most? And I'm not saying go out there and buy a whole bunch of junky stuff and low quality stuff, but you know what? What usually rises to the top the quickest is the worst, right? But then it settles down, but quality is always up there. So again, focus on quality, diversified portfolio with a plan. We'll get right through it.
Okay. Well, I do have some questions. If inflation peaks, what would happen in the markets?
Well, I think I pointed out, okay, we went down because we're fearful of inflation, right?
Yes.
All right, so let's flip that. If inflation has peaked and the Fed doesn't have to be aggressive raising interest rates, even though they might still raise rates, right? Because when we look at Fed funds rate and we look at the 10-year yield, the 10-year yield generally peaks out before the Fed stops raising interest rates. So if we get a peak in the 10-year yield, and you've seen this in the charts of late, anytime the 10-year yield has gotten over 3 or it's run up to 3.2, 3.5 at one point, you know, all of a sudden the market uses that as an opportunity to sell. Maybe not an opportunity to sell, it just sells. But when we start to drift down, what does it do? It tends to rally, right? So if we do believe that we're closer to the top, maybe use a baseball analogy here, maybe late in the innings, maybe 7th inning of a 9-inning game or 8th inning in a 9-inning game, heck, you could have 10-year yields peaking or yields peaking, Fed still raising rates because they're behind the 8 ball, we all know it. And then the market uses that to rally off of. And it sustains a rally, right? And it's something that the market can build off of and build off of. So I think, I think if we're going down because of high inflation, why would we not go up when inflation plateaus and starts to turn around on the downside?
All right. Next question. Are we in a recession? And if so, how long do you think that's going to last?
I don't know. No one can say. I love everyone out there. And again, I'll get on my soapbox a little bit. You know, opinions are great. It's why Baskin Robbins has 31 flavors, right? Not everyone likes vanilla, right? Well, everyone's got an opinion. And everyone has an opinion. Either we're going into recession, we're not going into recession, everything's rosy, it's not rosy. I don't know if we're in a recession. It certainly feels like it, right? You know, and I think sometimes we can just talk ourselves into a recession. My belief is, I feel by the time we get some economic numbers, I do not feel we're going to go into a recession. I feel it's going to be if we do, it'll be a light one, which means if we look historically, the markets don't have to go down as much. They don't have to go down as far, and we don't have to be as depressed as we are for as long. And I think that's a pretty rosy picture, but with the understanding is that we don't know that right now. It doesn't mean things can't get worse before they get better. But again, I don't believe we're as bad off as some individuals in the financial community believe, but I know it's not rosy. Let's put it that way. We got some challenges.
Agreed. Okay, is now a good time to invest?
Absolutely. I mean, and I throw this out, and I don't mean to be flippant. I know it's painful, it's uncomfortable. You know, it's like one of those things when the market's running, we probably get more calls than any. Hey, we want to buy, we want to buy. Well, I was like, well, why do we want to buy at the top? Why don't we wait when things go on sale? Right? I mean, if you're buying quality and the earnings are reasonable, there's a catalyst for the future, management's got their ducks in a row, maybe it pays a dividend, they're doing strong bear buybacks. Knowing that we'll get passed, why don't we buy things on discounts, right? And cost average down if we're down on something. So when it does go up, we're more profitable sooner and we're making more money. Right? Because again, we all know we're going to get past this. It's just when you're in the middle of the fight, right? And the bombs are dropping or the war and the bullets are flying. Boy, it's hard to see the direction, right? It's really uncomfortable. It's really painful. But that's when you got to kind of pull up your pants a little bit. You got to suck it up and you got to step in. And I think buying quality is the way that you do that. Just focus on quality. I don't think you have to go out on the big risk scale with these high growth stocks that don't have earnings. Just focus on high quality, and I think you have some really good buys. Heck, I know this is controversial. We've always been underweight bonds. I actually think bonds are looking a lot more attractive, right? I don't necessarily think that's an area you want to just go pile into because stocks still have trended tremendous outperformance over time, but I think it is very interesting right now because look at where the yields are, right? They moved up a lot, you know, in the market.
Yeah. Yes. Okay. Well, thank you, Graham. And that was a really interesting topic today. I'm sure everyone agrees. And as you all know, we post our most current information on our social media pages, such as Facebook and LinkedIn. And we also make sure that we keep our website up to date as well. So please follow us on social media and remember to check those pages out regularly. We have our weekly wrap ups on there and recommended articles and a lot of other valuable information. And of course, again, the website as well. I'd also like to take this opportunity to let you all know that we have scheduled our Retirement Planning Today class for August, and it's going to be at the beginning of August. These are multi-day educational classes, and they cover the A to Z of retirement planning process. So if you or someone that you know is at or near retirement age, please consider joining us for the class. The details can be found on our website, and we would love to see you there. Thanks again for joining us today, and we hope that everyone has a great afternoon and a safe and fun holiday weekend. And we hope to see you again next month. Thank you so much.
Take care.
Bye-bye.